Welcome to this lecture on risk and uncertainty. So the terms risk and uncertainty are often used interchangeably, but in reality, you can think about risk as the outcomes are random, but you have probabilities, those are known. Think about rolling a die or flipping a coin, then the outcome is random, but you still have an idea about the probabilities associated with heads or tails, or for example, getting 6 dots on a die. Uncertainty is where the probabilities are unknown and or at least ambiguous. So think here about a pandemic, the outcome of a war, or any sort of political change. Now, risk and uncertainty has relevance for public management economics, because think about decision-making in the context of budgeting, project evaluations, or any sort of regulation that is implemented in uncertain economic times. And this does not necessarily mean anything negative, but think about that the economy is evolving on a continuous basis, and that there's a certain risk and uncertainty associated with this macroeconomic development. Now note that most decisions that are made are forward-looking and are subject to risk and uncertainty. Note that this is true for consumers, the government, or also firms. Now, here are a couple of examples of risks that are affecting consumers and firms. You can think about yourself. The evolution of the retirement fund is to a certain degree uncertain. You can also think about the future of energy prices, such as gasoline, electricity, or natural gas. And then, of course, you can think for firms, for government, as well as for consumers. You can think about the adverse events such as accidents or natural disasters. Now, from an economic perspective, we are interested in, well, how can we quantify the risks? What can we say about the decision-making under uncertainty, and whether there is also a market and hence a price for risk? Now, this will be the subject of this lecture. Now, before we start, let us dive a little bit into probability and probability distributions. So think that the probability distribution would establish a link between outcomes and the associated probabilities. You can think about that there's a probability associated with each outcome, and the important part here is that the sum of the probabilities across all different outcomes equals 1. Now, let us have an example here about the investment opportunity in one of two mutually exclusive investment projects. So you have project A and project B, and their payoff depends on the state of the economy. Now, the economy can be either in a recession, in a normal state, or can be a booming economy. And think about that the probability here of a recession would be 40%, of a normal economy would be 35%, and of a booming economy would be 25%. Now, you see that project A and project B have different outcomes depending on what the state of the economy is. Now, there are two measures that are of interest to us regarding evaluating project A and project B, or think about evaluating the risk associated with those projects, and that those measures are related to the expected value and the variance. Now, the expected value, think about this, that there's a random variable x that can take on different values. In the context that we have just looked at, about those two projects, then that random variable would be the payoff, or the payoff associated with the project, which depends on the nature of the economy. Now here, you can think about the expected value that can be calculated of the sum of the outcome. So that would be xi. So for example, the payoff of project A when the economy is in a normal state, times the probability of that outcome occurring when the economy is in a normal state. So in the context of the previous projects A and B, you see the solutions directly with the expected value, that the payoff of project A is 3,600, and the payoff of project B would be 3,750. So here is how you would make those calculations manually. Now let us calculate the expected value associated with those two projects. Remember that the expected value is equal to where x is the random variable, or the project payoff in the different states would be the sum over all the states. So here it would be from 1 to 3. And that would be the payoff times the probability of that payoff occurring. So here, in this case, so we have for project A, we can calculate the expected value as follows. It would be, let's call this A is equal to the 0.4 times 4,000. So here we have the 0.4 here, and we multiply that by the 4,000, right? Plus 0.35 times the 5,000 plus 0.25 times 1,000. And when we do the calculations, we see that here the expected payoff is $3,600. So this is what we would expect if this occurs again and again and again. We would expect to get on average $3,600. Now for project B, we have the exact same calculations. Of course, here we have different probabilities and different payouts, but the concepts remain the same. So here we are going to multiply the 0.4 times the 0, the 0.35 times the 5,000, and so on. So we would get the 0.4 times 0 plus the 0.35 times 5,000 plus the 0.25 times 8,000. And if you do the calculations, here you find that the expected value of project B is higher than compared to project A, where the expected value is $3,750. Key to note here that for project B, that the expected value is higher, but you do have the possibility of a zero payoff in case of a recession, and you have the payoff of $8,000 in case of a boom. So when you're looking at the payoff profile of those two projects, then they're very different in the sense that you have a much larger spread here for project B than you have for project A. To capture this wider spread associated with project B, we have to think about the calculating the variance and the standard deviation. Now here, this slide summarizes the theoretical aspects associated with variance and standard deviation. But now let us have a look of how you can actually calculate those standard deviations and variance manually for those two projects. So in order to get the capture the variance associated or the spread associated with those two payoffs or those two projects, we have to calculate what is called the variance. Also, the square root of the variance is actually the so-called standard deviation, which has a much better interpretation. Okay, so you can think about the standard deviation that we are about to calculate. Not quite correct here, but you can think about this as the average deviation from the mean. Now there are two equations how you can calculate the variance associated with those projects. So one way is to calculate the expected payoff minus the expected value squared times the probability of that payoff happening. This is one way of calculating the variance. Another way of calculating the variance would be calculating the expected value of the payoffs squared minus the expected value squared. Okay, so here it is very important to note that those two terms are very different. Okay. Now let us do the calculations here for the two payoffs. So we have for project A, you can think about the variance for project A to be written as follows. So it would be the 4,000 minus the expected value, which was 3,600. Times the probability of 0.4. This would be squared, plus the 5,000 minus the expected value squared times 0.35 plus 1,000 minus 3,600 squared times 0.25. And here what you get for project A, the variance, that would be equal to 2.4 million, a little bit over 2.4 million, or if you take the square root of this, so the variance, the square root, you get a standard deviation of a project A of 1,560. And if you do the same calculations for project B, then you see that you have the standard deviation is $3,269 for project B. So what you have observed before, that the spread for project B is much larger. That is also illustrated here, that the 3,269 is much larger than the 1,560. Now, you see that the project A has a higher payout, has a lower payout than project B, but also the associated standard deviation is low. Whereas project B, there's a higher payoff, but the standard deviation associated with that project is higher as well. So in general, there's a trade-off between return and variance, in the sense that if you have stocks that are considered very safe, then those usually pay a smaller amount of dividends or returns than stocks that are highly volatile. Think about that any stockbroker or shareholder needs to be compensated for taking the risk, and hence the yields are usually high for risky assets. Now, think about here as another example related to the probability distribution, and here think about the fact about think about the casino and why casinos are making money. Here again, this is an application of the expected value. So think about that somebody offers to play a game where you flip a coin 5 times, and then the payout to the player is determined by the number of heads. So you take the heads squared, so you flip the coin 5 times, you get the number of heads, and then the payoff is determined by the heads squared minus 4 times the number of heads. Now, if P is bigger than 0, you have a profit for the player. If the P is smaller than 0, then the player has to pick. Now below, you see the payoff table, and you see that you're making $0 when there is 0 heads, but that you can make $5 if there are 5 heads. Now you see that here the associated probabilities with those various outcomes, and the expected value here for the player is actually negative. That means that if you were to play this game again and again and again, then you would make a loss in the long run. Now, think about every game in a casino is basically this payoff table, but reversed for the casino, in the sense that whether when it is a negative payoff for the player, that means it is a positive payoff for the casino. And this is how you would make money. Now, let us talk about risk preferences. Now, risk preferences, let us start with motivating this topic by considering 3 games. Note that for each game you have to pay $10 to play it. So in the first game you are paying $10, and what you get in return is $10. That for the coin flip, or for the second game, you flip a coin and you will receive $0 for heads and $20 for tails. And for the third game, you are rolling a die and you get $60 for 6 and $0 otherwise. Now note that the payoff for each of those games is $10 or $0 after you're deducting the cost to play. Although from an expected value standpoint, those games are identical, people clearly have preferences of which game to play. Note that here you can think about the standard deviations of the payoffs to be $0, $10, and $22.36 respectively. What this means is that the variance, the spread you're getting from playing this game varies significantly between those games. Now, one way of capturing the preferences or the risk preferences of individuals is with a concept that is called expected utility, which is basically the probability-weighted sum of the utilities associated with all possible states of a game, or think about this as all possible outcomes. And we differentiate here between risk-neutral, risk-averse, and risk-seeking individuals. Now note that most people are risk-averse in the sense that they are willing to give up a little bit of their wealth in order to avoid playing a particular game. Now, in the case of a risk-averse individual, expected value or the expected utility is smaller than the utility of the expected value. And what this means, we will soon see in a graph. Now, the risk premium associated with this situation where we have a risk-averse individual is basically the risk premium represents the maximum amount of money a risk-averse person will pay to avoid taking the risk. Now, let us have a look of how this works graphically. Imagine that you have a utility function that depends on wealth. That is simply the square root of wealth. And that the person with those preferences can engage in a gamble where you have the low wealth outcome would be, say, $16, and the high wealth outcome would be $81. And imagine that the probability associated with the low wealth is equal to 0.4. And then you can also calculate the expected value here. So here the expected value of wealth would be equal to the 0.4 times 16 plus 0.6 times 81, and hence the expected value would be equal to 55. That means if you were to engage in this game again and again and again, then on average you would expect to win $55. Now let us illustrate this situation here in a diagram where we have the utility on the vertical axis and we have wealth on the horizontal axis. So the utility function looks approximately like this. So here we have the utility of wealth. And let us mark the various components here. So we have the $16 here. And we have the $81 here. Now, you can easily verify that the utility associated with $16 is 4, and that the expected utility of, or the utility of $81 is 9. Okay, so here we have those components. Now, think about a connecting line that is connecting those 2 points, and that we have the expected value of 55. Let's assume that this expected value is here, 55. Good. So then what we have is we have here the utility of the expected wealth, and that would be, you can easily verify that this point, or the utility of the expected wealth, that would be about 7.42, right, which is simply the square root of 55. Now, note that you also have a point here, which is the expected utility. That is the expected utility. And that expected utility is simply the 0.4 times the utility of 16 plus 0.6 times the utility of 81. Or put differently, it would be the 0.4 times 4 plus 0.6 times 9. And you see that here the expected utility is 7. Okay. So here, this point is at 7, whereas this point here is at 7.42. Now note that this is for the risk-averse individual. And here you can see that the risk-averse individual is willing to give up a little bit of wealth in order to avoid the gamble altogether. So this value here is what is called the certainty equivalent. In the sense that this is the value that the player is willing to take in order to avoid the gamble. So here we can find this certainty equivalent. Note that since here we have this point is associated with a utility of 7, the certainty equivalent in this case is equal to 7 squared equal to 49. And hence the player here is willing to give up $6 in order to avoid playing the game. So the $6 here is what is called the risk premium. You can think about this from an insurance perspective, where you have the insurance, where you can have insurance either or where you can have either a bad outcome or a good outcome, and that you are willing to give up a little bit of your wealth in order to avoid the gamble altogether. Right? So this would be very similar to an insurance premium. Okay. So those are the risk preferences for a risk-averse individual. Now here we have another example of the expected utility, where we have two possible outcomes, that is getting $1 with 60% probability or getting $8 with 40% probability. Here the expected value of wealth is the 0.6 times $1 plus 0.4 times $8, which is equal to $3.80 or $3.80. Now the expected utility again is the different from the expected wealth, where the expected utility would be the 0.6 times the utility of $1 plus 0.4 times the utility of $8. Now, if we have a risk-averse individual, then the utility of $3.80 is bigger than the expected utility. Now, most people are risk-averse, but you can also have risk-neutral and risk-seeking behavior. And we are going to look at those cases right now. Now, in the case of risk-neutral preferences, you have again your wealth on the horizontal axis, and you have your utility of wealth on the vertical axis. And for a risk-neutral individual, the utility function is simply a straight line. Now think about the case before, where we had the two payoffs of $16 and $81. So now then you have a particular utility function associated with this. So think about this. That would be, actually, let's make it simple. Assume that here for this individual, that the utility function is simply equal to wealth. So here in this case, the utility would be 16. And here the utility would be 81. Now, if we have the same probabilities as before, where the outcome of 16 happens in 40% of the cases, and the outcome of 81 happens in 60% of the cases, then again, we have the same expected wealth, which would be equal to 55. But here, in this case, what you will see is that for this particular individual, the expected utility is actually equal to the utility of the expected value. Okay, so those are equivalent at this point here. Okay, so that would be 55. So this would be the example of a risk-neutral individual. Now, if we are looking for a risk-seeking individual, then we have a slightly different utility function. So here again, we are putting wealth on the horizontal axis and the utility of wealth on the vertical axis. Now, for a risk-seeking individual, the utility function looks like this. Okay, so let me just label this with a utility function here. Now, you can see that for this particular individual, if we are marking again the payoffs of 16, and 81 with the exact same expected value of 55. Then what we can do is, as before, we can draw a connecting line between those points. What we can then see, we have this point here. This point here would be the expected utility. Okay. Now, if you're considering this point here, this point is the utility of the expected wealth. Okay. So for a risk-seeking individual, the expected utility is above the utility of the expected value. Okay. Note that this was the opposite case for the risk-averse individual. Now, individuals, firms, and also the government can engage in so-called risk diversification in order to reduce risky outcomes. So think about that you have two investment possibilities that cost $10 each, and that it is in a raincoat company and a sunglasses company. Now, if the weather is sunny, then the value of the raincoat company is going to be $5, and the value of the sunglasses company is going to be $20. Whereas if the raincoat company, if the price is rain, or if the outcome is rainy, then the value is $20. Whereas for the sunglasses company, the outcome is $10 if it's rainy. Now, you can engage in risk diversification in the sense that you are purchasing 50% of each of those companies. Now, let us have a final application here where we are talking about insurance markets. So we have seen before that most people are risk averse, and that is not only true for individuals, but this is also true for firms. And now the question is, why do insurance companies exist? Now, before we get into the details here, think about that you are flipping a coin with two possible outcomes, heads or tails. And here the key condition is that the flips are independent. If I ask you to predict the expected share of heads, then you would say that this would be equal to 50%. Note that that probability does not change depending on the number of coin flips. If you are flipping it once, or if you are flipping it a million times, the expected share of heads is always going to be 0.5. Now you have here the variance associated with the n coin flips, and think about the intuitive explanation here as follows. If you are flipping the coin once, then you are going to predict that the expected value of heads is going to be 0.5. But if you're flipping a coin once, you're getting either 0 or you're getting 1, and hence you're off by 0.5. Now, the more you are flipping the coin, suppose that you're flipping it 10 times, then the probability of having 0 heads or 1 heads, or 0 heads or 10 heads, is going to be significantly diminished. The same is true if you're flipping the coin 1,000 times, then you're going to be very close to the share of predicted, or the share of expected values of heads, which would be 0.4. You may have, after 1,000 flips, you may have a share of heads of, say, 0.47 or 0.54, but you're going to be very close to the share of 0.5. Now, note that this is true for an insurance company as well, who can engage in something that is called risk pooling. Here, the example that I'm going to make is that think about the probability of a fire of being 1 over 250, or about 0.04%. The house value is $250,000, and the value of the house after the fire would be $0. Now here what I'm doing is I'm simulating the damage of n homeowners. So I'm going to vary n I'm going to assume different values. Then I'm going to calculate the share of homes that are burning down, in the sense that I can do that with a little simulation model. And I'm going to repeat that simulation about 1,000 times, and then I'm generating a histogram. Here you have the histogram or the density plot associated with this situation. Now, if you are having 1,000 people insured, so a relatively small number, then you see that the simulations that you can have times when you have no homes burning down, or you can have times when you have 1% of homes burning down. So you have quite the range of outcomes. But see what happens if you are actually increasing the number insured to 10,000 people, or 25,000 people, or even 100,000 people. You see that, for example, with 100,000 people, the number of homes that are burning down is not zero anymore. So you're always going to have homes that are burning down, but you're also avoiding the losses of, say, 1%. So this is very similar to the coin flipping example, where it is much easier to predict the share of heads of, say, 1 million flips than of, say, two flips or 3 flips. So here, the insurance market or the insurance companies exist because the variance is decreasing the more people they insure. Now here, of course, the important assumption is that the events are independent. This does not work if you're thinking about, for example, for flood insurance, which is the reason why it is subsidized at the federal level.